Well, welcome everyone. Sorry, we've got a small audience, although sometimes that's great because you can have more one-on-one interactions. Everyone else is at Burning Man. So hopefully they're enjoying that. We've got a great panel tonight. I've interviewed most of the people on the panel and they're really interesting. So I think we're going to have a really great conversation. To start with, though, I'd like to introduce Phil Lambert. He's the host for tonight. He's given you the wine and goodies.
Yeah, I just want to say welcome. I'm a patent attorney here at Shepherd Mullins, so it's great having these meetings here. You know, you and the audience have a real treat tonight because it's a really, really small group. Usually people are standing out in the hall and even in the street. So you and the audience shouldn't feel I don't know,
you can
dismissed, but welcome back, because they come again and they'll be mobbed out here outside the door. So thanks a lot.
Thanks, Bill. So if anyone wants to speak to Bill, he'll be around in the networking afterwards, and you can have a word with him. And now I'm going to pass it over to Blake, and Blake's going to then let everyone introduce themselves. And he's the moderator for tonight. Thanks, Blake.
Hello.
Have you turned it on? Press it.
We can hear you though. Yeah, like we can hear you.
You got it on?
We need it.
We need it for the video.
Yeah. This one works.
I'm wondering if the battery's gone. Thank you. Got to have a tech expert. Thanks, Blake.
Hi, I'm Blake Richmond. I'm the head trader and portfolio manager at NovaBlock Capital. We're a blockchain and distributed ledger technology investment fund, doing everything from ICOs to liquid markets to equity investments to convertible instruments, very flexible stuff. Very interested in the smart contract space and the emerging security tokenized security space.
Hi, my name is Daniel Edwards. I've been in the cryptocurrency space, trading and mining since October of 2011. I was mining a little bit on an old gaming computer that I had in college to make some extra money, and that's originally how I got into the space. But went into investment banking out of college, and then I ended up helping start a gaming company, CashBet. Came in 2 years. It started in 2013. I came in 2015, and we became the first regulated crypto gaming company in the world. We were also the first blockchain company to sponsor a major league sports team, which was Arsenal Football Club out of London, and led the team to do a $38 million ICO. And since then, I've left to start my own gaming company, and that's what I'm doing currently.
Hi everybody, it's a pleasure to be here. My name is George Li, and I'm the CEO and co-founder of WeTrust. What we're building right now is a fundraising platform for nonprofit organizations. So if you're a nonprofit, you can go on the platform, create a profile, and crypto community folks can go in there and find the causes that they support, the ones that they believe, and they can fund and support them. And one of the cool things about this is we want to use blockchain as a way to reward people with collectible items when they make these donations. And then secondly, we want to build upon the crypto ethos, which is to have a lot of engagement between people in a certain community. So if you donate to an organization, you can communicate easily with the peers who also support that cause, as well as easily communicate with that organization. I'm happy to talk more about it after the event.
Thank you. I am Benedict Chan. I am the CTO at a company called BitGo. We're in Palo Alto as well. We put trust into digital currency. We've been a wallet platform for some time. We're used by about 100 or so or more digital currency exchanges, and we do about 10 to 15% of all Bitcoin transactions, lots of volume, and we're also, in play to perform custodianship services.
I'm Daniel Cawrey. I'm the CEO of a firm called Pactum Capital. We do finance for blockchain. We have a fund. We're active traders in the market with UOTC, and we work with exchanges. So our major clients are accredited investors, ICOs, and exchanges.
So we're here to talk a little bit about security and specifically storage of digital assets in the cryptocurrency blockchain space. So I guess let's start with what are the options? Does anybody want to jump in? Or?
Well, I mean, I can tell the story from the perspective of what we've done. So our strategy is actually not to hold any cryptocurrencies. We go into the market, we trade every day, and then we go back into cash. So our whole model is not even to hold cryptocurrency because we looked into custody for a long time, and there was really no good option. There was no qualified custody, no good regulated custody. I know now, today, there are, I think, some options from BitGo and Coindesk, but at the time when we looked into it, because our clients were asking for it last year, there really wasn't anything great out there. But I do think that that's changed now.
So I'll take it from more of a consumer perspective. I always like to kind of think from the consumer's side of thinking. So there's either a hot wallet or a cold wallet. And if you're storing on a hot wallet, that's usually an exchange or some other kind of online-based wallet. And then a cold wallet is something like a USB stick or something that you're using, a Trezor ledger, something like that. And I think the interesting thing here is that cryptocurrency blockchain is asking the end consumer to become the bank. So you're asking the end consumer to then be responsible for holding that currency. And I think that's something that needs to be looked at heavily, because if you ask my grandma to be her own bank, that's probably going to be a very bad experiment. So the thing I like to take this back to is I'm from the gaming space after investment banking, and a story I like to tell is that in Latin America, the gaming infrastructure and banking infrastructure is not great. So what will happen is if you want to game on an online site, you'll go to a bookie, give the bookie dollars, that bookie gives you then some kind of alphanumeric code, you enter that on the site and you play. Now that bookie takes the money back home and stores that in their house. And everybody knows that that guy is the bookie for that site. And so he's able to be robbed at any point in time. Everybody knows that's where he lives, and if he gets robbed, the money's gone. That's kind of the same thing that you're looking at for a lot of these hot wallets or other things. They know where the money is. They most likely know how to get it. It's just about security. So to me, it's interesting. You even want to look at things like Coinbase, which I would say is probably the leader in the industry, 20 million plus customers. And what they do when you give them their money, 2% is stored online in the hot wallet, and 98% of it is stored offline in a cold, secure storage. Now, what they do with that is that they take it, they replicate it, they encrypt it, and then they put it on USB drives, and they store those in vaults in locations all across the world. This is a pretty interesting tactic, and it sounds pretty familiar to what a centralized banking infrastructure would be doing. So you're talking about it's decentralized and everybody owns it, but it acts exactly like the centralized world. So what we need to think about with cryptocurrency and storage, I think, is are the average consumers ready to be their own bank?
That's exactly the question I was going to ask. Benedict, do you have something to add?
Yeah, I think that for many of us that have been in this space for a while, the fact that we could control our own money was a very big attraction to the digital currency industry. Having said that, I think the answer to the question of how should I store my cryptocurrency depends a lot on how sophisticated you are from a technical standpoint right now. And for the most part, not everybody needs to be their own bank, especially if we're thinking about driving this industry to a state where everyone can be a part of it. You don't want everyone to have to be the individual banks and be holding their own keys necessarily because they may not be able to secure them. Maybe somewhere down in the very, very distant future where we have some kind of really great solution or secure enclave on everyone's phone where both from a hardware standpoint it's great and from a usability standpoint it's great. We might get that. But right now, what's key is that you don't always encourage everyone to open up their own bank. Now, the key thing to see here is that we're not saying everybody should put their money with Coinbase, everybody should put their money with BitGo. The fact that you can control your own money is actually in itself a very powerful thing, and I would say one of the core beliefs as part of creating digital currency.
That's your question.
Yeah, the question here, just to clarify, when we talk about digital assets, we are talking about currency. So are we talking about, for example, birth certificates or land title and things like that, or are we only exclusively talking about some form of money and currency?
Yeah, I think the word cryptocurrency is a little muddied by whether or not it's just value transfer or not. I think the word digital asset is probably more appropriate here. Did you have
I would just say I think it's both things. I think there's the cryptocurrency, which is kind of what everyone is doing right now, and that's what we're talking about trading. But then there's also digital assets, and digital assets could be anything, like you said, a birth certificate, contract, form of ID, really anything. So right now we're talking about transferring digital assets, but transferring cryptocurrency, but transferring digital assets is in the same realm. It's using the same technology.
Anything which is controlled by a key.
Yeah, the reason I'm asking is that I have heard every one of you talking about some form of currency, not about titles or certificates.
It applies broadly, right?
It applies broadly to every digital asset that's stored on the blockchain. I mean, fundamentally, what these storage mediums are is just different ways of storing the private key that gives them access to the data that you've encrypted on the blockchain.
Yeah, but if as a school I store school degrees in the blockchain, I'm not going to become back. Am I? No.
Well, it's just as important though that you don't allow anyone to take your keys and sign off on a certain number of others that have not actually got their diploma or their degree. So it's not whether you're being a bank in that sense, but the security of your key is just as important in that case.
It's not necessarily a banking relationship, but it still is the custodian relationship. So which storage solutions have we personally used or evolved over time? I know George had some, didn't want to be too forthcoming on this topic. So, as vague as possible. But.
Well, I mean, I feel like one of the basic parts of security is privacy. As we alluded to just now, if you know how much money the bookie has and where he lives, that can't be a good thing. So people will typically not talk about how they personally secure their digital assets. But having said that, I think many of us have tried quite a number of them. And hot wallets, hardware wallets, multi-sig wallets, or a combination of all of those, I think are all good solutions, but it really depends on to what level you can undertake those. So you really have to look at how you want to be using the wallets, right? If you're going to be running an exchange, then you definitely need, or at least if you think you need, some kind of online wallet to service withdrawals in an online manner. Then your challenge there is how to limit your risk by maybe using a hot wallet or a set of policies around multi-sig where you don't let too much money out within a certain amount of time. Whereas if you're running like a hedge fund or a bigger organization that wants to do a buy and hold approach, then you could say take a larger amount of hassle or care on securing your keys. Put them in a distributed number of vaults, and maybe if it takes you one day to access your funds, that's something you're okay with. And if you don't consider yourself to be the most technically safe in that maybe you use your computer for many other things other than storing cryptocurrency, then maybe the safest thing would be to put it with a custodian.
So you bring up a good point there, sort of the spectrum of one, who the user is, and two, what solution they should be using. What do you think the best kind of middle ground is for the average consumer?
I think that for the average consumer, right now you might be holding, so it depends on how you use it. For the average consumer, I would say many people, or at least for me, buy and hold seems to be a good long-term strategy. There can be many traders. If you're a trader, then you probably want to have some hot amount that is available all the time, and then you have another cold wallet, which is maybe multi-sig, has multiple people on it. Or if you're just an average consumer, then just put it with a custodian.
So I think it comes down to liquidity in my mind's eye, and what the consumer needs as far as liquidity. So he nailed it as far as timing, saying, what is the consumer's spending habits and what are they looking at doing? If they're buying and holding, then they can do a lot of different things. They can keep it on a USB drive, they can put it into tin or wood or some of the other things that you've seen out there that are very secure. There's even a synthetic DNA option where you can inject the code into synthetic DNA and keep it for 20 to 30 years. Those are very like buy and hold, but the thing that really interests me is more of like a daily consumer activity, so something that's very liquid. So personally, I hold some of mine in cold wallets offline, and if I'm looking to transfer those online, I either need to be wherever those are stored and go get them, which can be very cumbersome. We at my last company that I helped run, we had them in a bank vault at Wells Fargo. And so every time we needed, a large transaction to go through, I had to go to Wells Fargo, get somebody to open up the safe. Then I had to have somebody escort me back to the office because, we always held custody in twos, and no one had full custody of all the wallet at every one time. And it was just kind of a hassle. And that's very illiquid in my mind's eye. And I think for an average consumer, if you're going to Starbucks and you have some on a wallet, and it's a hot wallet or whatever you want to say, and you don't have enough to buy that coffee, and you got to go home or wherever your cold storage is and top it back up, that can be a very horrible process. So I think there's still technology that needs to be built to kind of make consumers feel safe about that. I'd say most consumers right now are 100% happy with hot wallets, and I like to go back to Coinbase on this because most people that are the average consumer use them, and they have an insurance policy. So they, like I talked about earlier, they have 98% offline and 2% online. So that 2% that's online is backed by an insurance policy. So they can never lose that money for customers. Or if they lose it, the customers never out money. They always get their money back. So I think that's something that makes consumers feel comfortable with using Coinbase, but not every solution that's a hot wallet like that has an insurance policy. Actually, most of them don't, and that's where you hear things like Mt. Gox or other things where people completely lose all their money, and there's nothing they can do about it.
I think at Mt. Gox they claimed they had a cold wallet, but to quote what they said, our cold wallet leaked into the hot wallet. And I don't know how that's possible, but
well, they claim they had real on-exchange volume too.
Okay, so speaking from our experience working with nonprofit organizations who are basically not in the business of blockchain, their sophistication and knowledge of blockchain varies from beginner to fairly sophisticated. And so we've written some blog articles on our website to help them and other nonprofit organizations in the future to onboard to our platform. And so I think the answer really depends on kind of how deeply someone wants to get into the crypto space and how they want to start. And by starting, usually you need to buy some crypto coins. So that typically limits you to Coinbase or a few, very select few exchanges. And so that's typically how people can start. And then I would say as you become more interested about the technology, hardware wallets become another option where you can start testing and doing things like that. And I think that's the path that many of our partners have taken as well.
Yeah, that's the path I personally took from hot wallet to paper wallet to spending hours trying to figure out how to sign that transaction out of it to a cold wallet. Do you have a question?
Question, more clarification. What do you talk about here in these meetings? Storage. We are talking about storage of private key from the consumer side. Is that correct?
Yes.
Well, it could be enterprise.
Or enterprise.
From the user side.
Yeah, from the user side, whoever initiated the transaction. I send and receive.
But I think you bring up a good point that these available hot wallet services are sufficient. But is this the end game? Is this enough? Dan shaking his head down there.
I did look deeply into this, and to Ben's point, yeah, it is really interesting that you can be your own bank with cryptocurrencies or digital assets or whatever you want to refer it to. But when you look at like the financial markets, you look at like something like Robinhood. When you buy a stock on Robinhood, it's going through like custody, and there's like some safeguards in place to keep people from losing their money. And I think we're going to see a lot of that in cryptocurrency as well. The problem is how the regulators are going to sort of adopt. Are they going to adopt new frameworks, or are they going to use existing custody frameworks? And I think that's kind of like where we're at right now in terms of like what the regulators are going to do. Are there interesting technical things that are happening, like with storing keys and so on and so forth, and hardware wallets and all these things? Yes, but there hasn't been like a true answer from like the regulators on how this is all going to work out. So this is why we've just like, with my firm, we've just been really pessimistic about how this is all going to shake out. So we don't hold anything for our clients. And I'm hoping, in the future we'll find a good third-party solution for that. It just the clarity around it just hasn't been there. And our attorneys have just told us to just take a cautious approach and look at different business models than just doing custody for the time being.
So when you talk about regulatory concerns, is that around liability or like possibility of being subject to seizure by authorities, or what kind of concerns?
Yeah, I mean liability, insurance, audits.
Changing regulation.
Changing. So again, I don't know if it's necessarily changing regulation, but
Enforce regulation.
Well, yeah. So how will they enforce it? Inside the industry, from a lobbying perspective, where a lot of entrepreneurs are asking that the regulators adopt a digital asset framework, but the regulators are pushing back on that. And so therefore, it's my belief, and based on what folks like from the SEC have said publicly, is that they're just going to use existing laws to enforce these sorts of things. And it's I can't believe the amount of time I went and looked at this, because it did look like a good business opportunity. But for my firm in particular, we're just going to sit and wait, and at some point there will be a good, third-party solution. And again, I know BitGo's working on something, Coinbase has been working on something. We've long been in conversations about this stuff. I just have to be careful of what we do for our clients. So, does that answer your question?
I think so.
Okay.
I mean,
If I could throw a comment in here, what I think is happening, I'm in a trust company, we went to a trust association meeting a few months ago, an SEC regulator there. I think there's a light touch approach going on here, and they're trying to see what's happening, a little wait and see, kind of see, let it sort itself out, best practices. Well, it's really not that big in a consumer way, like affecting that many people. So I think regulators are kind of just stepping back a little bit and waiting, and then let itself sort itself out, and then kind of put regulation in or not.
Well, no, because I am regulator friendly, and I've gone and met with the regulators, and they mostly just asked me what I thought.
Yeah, right.
Right.
They're trying to learn.
And they just want to know what we were doing, They wanted to know what I thought about the market and the nature of the market. And I'm just concerned that we've always tried to follow what rules there are that do exist. So we're just taking, basically what we do is, like, my co-founder comes from running a hedge fund. So we're just doing the same thing with looking at cryptocurrencies, specifically Bitcoin, Ethereum as commodities, and then a lot of the other stuff may at some point be securities. So we're following all that because I think as a fund, we want to have like a long-term 10-year plan for where we're going to be, and we don't want to run afoul of anything. And so we're a lot more conservative than I think a lot of other funds are in the market. And I'm just trying to survive. Last year there were a lot of funds that just exploded with buy and hold. Those funds, unfortunately, aren't doing very well now because they have custody of an asset that may or may not be illiquid, right? That's what's been happening.
So going to the regulatory perspective and the options out there, when I was an investment banker, I worked in the FinTech space and I dealt a lot with financial institutions. And if you want to see where this thing's heading, just look to the banking infrastructure system and how banks are regulated in America. So if any bank is holding any type of asset in America, they have to be chartered and they have to be regulated. And so my guess is that in the future in America, whether you're an exchange or a wallet, anything that's holding currency for other people or individuals, and they deem those assets something like digital currency or fiat money today, then you'll be regulated, and you'll probably have to have a charter or a license that they'll give you. Kind of like we've already seen with the Bit license in New York a little bit. Basically, they just want to have an eye on you and know what you're doing and who you're interacting with. So that's kind of what I think from a regulatory perspective. And what that will do is that will really squash a lot of the smaller startups in the space. So an example is it's very, very hard to open a de novo bank. And that means basically a brand new bank on the street. It takes a lot of capital and it takes a lot of regulatory burdens to get that bank up and going. That's why you rarely ever see a new bank open up its doors. And actually the number of bank branches in America has been declining rapidly. And it makes a lot of sense. Regulation has squashed it. So if you want to look at cryptocurrency and blockchain technology for holding assets, if they deem that you're holding an asset and they regulate that, it could make it much, much harder for startups in the space to get in and start competing with institutions that have the capability to throw the capital and the regulatory assets at it to make it work.
Well, I think there's a huge opportunity in third-party custody in that respect. And what my firm will do is we'll just work with a third party that we have trust with, and that's how I think it's going to shake out. The idea of being your own bank is great, but when you're doing it for other people, we're going to have pretty good rules around that at some point. We're going to have there's going to be another price escalation, and I was talking about this with some folks before this started, but as the price was escalating, I would be getting emails and phone calls all the time, custody, can you custody my assets? And we couldn't, because there wasn't really anything out there. Now that we're in like this fallow period, some things are starting to develop. So when this happens again, I'm hoping there'll be somebody I can call. Right, Ben?
Trying to say yes.
Right? Say yes, just say yes.
Yes.
Well, it's great for the, at least at the institutional level, or hopeful, at least at the institutional level. But for the average consumer, is the Coinbase hot wallet, one, the easiest thing to use, and two, is it the best security solution?
Well, I mean, like we were discussing this kind of just now, in that for the average person, they need to see whether they're actually capable of holding those keys. And in such a situation, I mean, to speak to why I think certain regulatory clarity is great, it does provide like a basic, I think, standard of care, right? If someone has got a trust license or a banking license, then you know that they've performed a very minimum set of checks in there and processes that they're able to take custody of of customer funds. And I think that's kind of the point of this regulation at all. I think that it will actually enable people to look at the Coinbases and BitGos and say, okay, look, that seems to be somewhat licensed. It's not an empty box somewhere else. It's not maybe. And the point I think is that for me, I think that it won't necessarily kill off a large number of startups. I think there are a lot of startups that are innovating in maybe insurance space or charity space or in many other use cases of blockchain, but they don't necessarily have to be the ones that are storing money. There's so many businesses in this country today that don't have to store their customers' money, and they use a bank for that.
So we've talked about the consumer, we've talked about enterprise and institutional investors, but the last, honeypot in this ecosystem is really the token sale projects. Does anybody have any insight into sort of the security, storage, and treasury management solution that they're working with?
So we did a $38 million ICO. We got a lot of different cryptocurrencies from that process. And I definitely had my opinions on how we would have been storing it. And I think we went the other route. And we ended up doing a lot of what I would consider traditional mechanisms. If you got a big pile of cash, what would you do? You'd probably run straight over to Wells Fargo and deposit the money. And I think that's how, unfortunately, we ended up doing a lot of that process. Even if it moved on to some kind of a ledger or Trezor or whatever, it went straight into Wells Fargo, and that was the process. And I think there was, and not even just talking about any ICO has very little knowledge in how to handle money. And so they think, okay, it's on a USB drive, it will never fail. That's not that's not true at all, right? So they also don't, very rare if you talk to somebody handling their own money that does an ICO that has parts of the keys that they need broken up. So one person isn't handling one of the keys. So that's pretty interesting. Also, they don't ever think about paper wallet or putting it into some kind of metal or engraving or something that's not digital. And I think that there's a lot of just green pasture and open space for companies or startups to come into the space and offer solutions for that. Because I think the first thing on any company's mind raising money is raising the money. And then when they get it, they kind of go, wow, awesome. Now what? And most of them also don't know treasury management at all. I think we were fortunate enough that I had an investment banking background that I knew about treasury management, and that was one of the first things that I thought about even before the ICO was complete, was how are we going to diversify funds, how are we going to diversify holdings. But going around and doing the whole conference circuit for a long time, I can tell you probably 99% of all the other companies I talk to aren't thinking about treasury management. What they usually do is they have a market maker that helps them with market making for the token and driving the price hopefully upward. And they also put off a lot of the treasury responsibilities on those same market makers. And they say, here's some of our cryptocurrency, it's $5 million in ETH, diversify it, whether that be fiat currency or fiat or other digital currencies in the crypto space. And I think there's still a lot of room to go, but I would say the approach for most companies is very unsophisticated.
What would be a better solution? Where should this go?
I hate to say bankers or treasury managers, but I think even a startup solution or platform that could offer something in the space or guidance in the space to say, okay, you just raised $5,000 in Ethereum, what do you do with it? What are your options? It's the same as if a human walks into a brokerage firm and says, I have $5 million, help me diversify it. That's solutions that you don't really see relatively available out there. And I think a lot of startups, because the space is so new, aren't really thinking about that. They think about, okay, most of the time we sold everybody an idea based off of a white paper. Now we got to build that idea. And the last thing that they're thinking about is treasury management. Most of the time they're just thinking about, okay, do I still have enough ETH in my bank account or converted it to fiat and have enough in my bank account to fund the project and fund payroll? And they're not really thinking about like, okay, well, what happens to the price of ETH in, 2 years from now, 3 years from now? I mean, it's the same if you want to go look back and look at the banking crisis. People weren't really thinking about homes going down in value. They were thinking, I got the home, acquire more homes. And that's usually the thoughts of these startups. We got the crypto, acquire more crypto, and it's never going to go down. But that's not reality.
So Benedict, I wanted to ask you, what's the state of development in the wallet space? Are there emerging features? What's sort of the competitive advantage that you're seeing amongst wallet developers?
Yeah, sure. I mean, in the wallet space, there's many dimensions that people look at. How many cryptocurrencies can you support? That's a big one. There's the security that we've all been talking about, whether it's a hosted wallet, whether it's how cold is it, is it in many different geographic locations. That's been constantly developed. I think that more and more we're seeing, processes that we're borrowing from traditional finance. So, for example, when we talk to some of the large banks that are using our software, they'll ask us questions like, we want to have 2 teams of people. One of them does the approval, and the other one actually does the going into the vault. Or there's one team that does the kind of processing, and the other one does the approval. And so we're borrowing a lot of those ideas and implementing them. It's not rocket science. These processes have been used for securing assets for a long time, and we just need to apply them here. On the hardware side, I think it's interesting that there's more and more HSM modules or secure elements that are becoming more and more commonplace. So now on most modern Intel processors, you have an Intel SGX, which is a way for the chip to separate out at the BIOS level a secure set of memory, which is different from your main operating system. And so I think that this is probably going to be the trend going on phones as well. On many iPhones, you have a secure enclave as well, where the key is inside that secure enclave, and no one can read that memory directly. And this enables us to get closer and closer to the point where someday people will be able to take their own keys. And it lowers the cost of doing hardware security.
Thanks. So George, let's talk WeTrust.
Yeah.
What keeps you up at night from a security perspective?
So I think this is one of those things where we have, we've seen what's happened across the space, kind of what he's alluded to as well, and we rely upon custodian. And we're in the business of building great products, getting users, great user experience, and so forth. And it's really, you shouldn't need to also spend so much time on securing these funds, right? So we use BitGo, and we think that there's a lot of great solutions out there that can be used. And I think there's no solution that is 100% foolproof, but you have to kind of decide where you want to invest your time and effort. And so I think for most people, I would say using a solution like BitGo or Coinbase is probably the best bet, because you're more likely to lose your keys or misplace them or forget something than for someone to actually right? And I think that's what Dan and both Dan and Ben said. In the future, when there's a better way for you to secure your own keys, I think that day will be very soon, because there's so many people working on this. HTC, or if I remember correctly, there's a company that's building something on the phone, and no one knows, and there's going to be trial and error, but I think some solution will come pretty soon.
So
One second. I'd like to go back to something that many panelists have said earlier. What do you mean exactly that the consumer has to become his own bank? What do you mean by that?
That the consumer is the custodian of their own funds rather than a third party.
Don't we do already this today?
No.
When we have money, we put it in
The
our
majority
drawer,
of my funds are held at a bank.
Sorry?
The majority of my funds are held at a bank, and I think most of the
Yes,
people
but
could say
we
the
have a
same.
key to access our account.
Right.
So what is really different?
Right, I think
It's the same thing. We have the keys to access our account, but we don't
And
have
that's
to
a credit
wait
card.
until 9 a.m. the next day if we want it at night. It's something that that can't be frozen by a central issuing authority. Something that can't be confiscated. It's something that there can't be a bank run for.
Yeah,
You're
I have the choice
eliminating-
also to get my salary in cash and put it in my home if I want.
Right.
So then, am I my own bank? If I do that?
Yes.
She's asking what is different in the new world now.
Right, yeah, well, it says what is really new, that's what I don't understand.
Yeah, so you're 100% right. If you take all your money from your job and stuff it under your mattress, you're your own bank. So if your house burns down, if a robber comes in, steals it, anything happens, you're liable. You don't get your money back. As opposed to a financial institution in the centralized world like Wells Fargo, if he goes and stores his money, Dan goes and stores his money in Wells Fargo and the FDIC insure his money to always be there up to $250,000. So if Wells Fargo burns down that location.
Yeah, that's because I made the choice to open an account at Wells Fargo.
Sure. So with
Because I want that protection.
Sure. So with cryptocurrency.
With cryptocurrency, I may choose to do it myself.
Sure, which is what we're saying is that you have that ability, but if you go to another institution like Coinbase and you're basically using them like Wells Fargo, they'll ensure that your money in that hot wallet is protected. And most consumers right now, the thought of them storing their own cryptocurrency or their own fiat under their bed is mind-boggling. They'll do it to some degree, but they won't put $250,000 under their mattress, right? Because there's no security that it will be there in the morning. Whereas Wells Fargo, you may have to wait till 9 a.m. to access your funds, but you know that they're going to be there. With cryptocurrency, it's an educational process. We've taught the consumer that a third-party institution will hold their money for them and then it will always be safe. And so now you're kind of giving them something and saying, now we're going back in time to when you used to store your money yourself under your mattress or in your closet or in your vault, wherever. Here's that same capability. Now, the thing that you can do with crypto and digital assets that you can't do with fiat is that you can't trade that dollar under your mattress to someone in Venezuela or something, or Brazil or wherever overnight. With cryptocurrency, you can. And it's faster, it's cheaper, and it's almost instantaneous. So now we're talking about you holding your own funds, not having to wait till 9 a.m. when Wells Fargo opens up to do a bank transfer that could take 3 to 5 days and isn't guaranteed.
You also can't keep backup copies of the currency under your mattress.
I had a question, just transitioning from cryptocurrency to digital assets. As an example, if you take healthcare as a good use case for blockchain. And what I'm learning is typically you don't want to store a lot of large documents. Like for example, the medical space or the healthcare space, let's say we talk about MRIs, which are very large documents, right? Images. They recommend that you can't store them in blockchain because the idea is to keep that very lightweight. And if you have to store outside of blockchain, for example, through IPFS or something, how secure is that? We keep talking about blockchain being very secure, but at the same time, when we talk about digital assets that can take up space, we say, hey, you cannot store it there, you have to store it outside and have a hash in the blockchain that will point to such digital assets. So what are your thoughts on security? Right? I mean, because you're basically, I always thought you're compromising on this because you're storing it in IPFS, which may or may not be as secure as the typical blockchain.
So in that case, are you saying talking about security of loss, meaning you're afraid that the MRI images will be lost?
No.
Or that someone will change them?
Yeah, two things, right? Not lost, but my privacy. I mean, confidential information is probably outside blockchain. in an IPFS, which I don't know, maybe it is more secure than what we have today. So one is privacy. Second is a change. Change again, if somebody has accessed it, even they have not changed, that's bad enough. Because if they change, anyway you would know in blockchain because the hash.
Right, so the blockchain does solve the not allowing it to be changed.
Correct.
By storing it elsewhere, if you store the entire file,
The entire medical history, right?
or whatever it was, right? Like you wouldn't want that to be accessed. So I think privacy is a separate matter altogether. And for that, it depends on what cryptographic techniques you use, whether you're kind of encrypting it and how you're distributing that and how safe your keys are, which is related in terms of from a cryptographic key security perspective, but you don't necessarily need a blockchain to store to keep your privacy.
Yeah, I just from being in this industry for 5 years, I fail to see where blockchain actually solves a problem in healthcare.
Yeah, sure.
But I apologize. That was the premise of the beginning of your question was blockchain is beneficial.
They say healthcare is a great use case for blockchain.
But I just see so many other problems with healthcare that putting a blockchain on it just doesn't. That's just my opinion. I mean, cryptocurrencies and blockchain are used for speculation, and we really haven't found like a real good use case otherwise yet. Will that change? Maybe, but I think that there's probably some privacy and security issues with it.
Well, it'd be a data-heavy architecture too, and for a pure blockchain, the way that we actually think about it, that doesn't work. For a permission database or a high-throughput proof-of-stake type model, that's going to be able to handle that type of data. That's going to be a lot more efficient. But then you start to get into the compromises between security and decentralization.
There's also two differences here. You have to know public blockchain and private blockchain. So in your instance, there's no way that would be stored on a public blockchain, right? It'd be stored by Kaiser Permanente or some other health system, and it'd be a private blockchain. But then you have to start talking about, okay, well, if the whole point about blockchain is to allow other people to view the records who have access to that, and then also allow for privacy. The encryption easily gets them into, say, you break your leg and you're in the middle of the desert at Burning Man or something, and they want to see your medical records. If they have some kind of encryption to get into that, and then they can view that, as opposed to now where it's stored centrally on all these servers, and you may not have access to get into the Kaiser Permanente architecture. So, I mean, that's kind of the benefit there, but there's no way you could handle, at least for the protocols we're seeing currently, there's no way you can handle the amount of volume for live updating medical records. Yeah. It would have to be side chains, and it's all private blockchain. Yeah. And you'd never want to post any of that information, even if it were encrypted, into the public network. It's just kind of like throwing, food into the water and hoping the sharks don't get it. And there's always a possibility that they could.
Yeah, thanks.
Yeah, I mean, sure. I can go on and speak of how we can use blockchain on healthcare. I think I actually don't believe it's the best use case. I think there are use cases. One area that you could use it in is for tracking the medicines. So say you manufacture a lot of medicines, which you can track the distribution of, and you want to make sure that it doesn't fall into the wrong hands.
Yeah, supply chain is a very good use case across
of
industries, right? That's what I think. Supply chain across industries, very good use case for
and you would be able to see where it went, who took the medicine, who signed it out. So maybe that's one of the use cases, but I don't feel like I don't feel it's a strong sell.
Yeah, I think there could be uses in healthcare, but healthcare itself is such a broad industry. Yeah. So there might be select areas in healthcare, maybe the intersection of healthcare and supply chain, intersection of healthcare and something else, patient results, efficacy of certain things. So it just kind of really depends on the situation, I think.
I have a question about data storage and database. The whole premise of the blockchain was that instead of a central database, we have a more secure distributed storage mechanism with the ledgers, digital ledgers.
Is that the premise?
It's one of the main value proposition, right?
I'm not sure. Is that sort of yes?
Immutable storage of data.
Yeah,
That's
Yeah.
Yeah,
So
okay,
my
yes.
question
That's very
is,
different from what you said though.
I mean, the example you gave about the healthcare, you know, checking information on a central database is not necessarily easy to allow people to manage both. But having it duplicated in ledger make it more efficient. That's what you said, right?
That's one use case.
That's one use case, right? So my question is security and this flexibility of ledger a strong value proposition for the blockchain versus a centralized storage?
Well, it's fundamentally encryption.
Hmm?
It's fundamentally encryption. So whether you have a permissioned database that is encrypted, or whether you have a blockchain that's a SHA-256 proof of work, you're both in both cases you're using a database and it's encrypted data. The difference there is one, the permission database, you can choose who has access to it and who can change it and what that conditional change is. Whereas a blockchain, the only condition is that the unspent transaction output exists for that new state transition. And in a public blockchain, anybody can apply a transaction.
I think maybe try to answer your question. What the blockchain is good at is a consensus. It's a canonical source of truth that people who don't trust each other can say, hey, I trust this. But in many cases, say, for example, an MRI at a hospital, there wouldn't be maybe a strong reason to distrust the hospital for changing your MRI. There would be very little incentive, or there would be very little for them to gain by changing something. And so, in many cases, I think the question really is there a huge benefit? Is there a huge cheating issue that you want to prevent? And in the case of hospitals and MRIs, usually there's probably no huge incentive for them to swap out the MRI image. Because it hurts you but doesn't benefit them. That would be the presumption. But for blockchain and Bitcoin as a store of value, then there's clear benefit if someone were to adjust the ledger or a bank. If your money, the number was changed, someone definitely benefits because someone gets a plus and you get a minus. And so the question really is, in what other kinds of databases are there data where there is this kind of huge problem where you can, someone can clearly benefit from the other? That would be my kind of first question to ask.
For Ben, as the institution, there's no right now the current state streets and all the custodials of the current world aren't entering in crypto yet. But when they do, and is BitGo kind of afraid that they would take all the customers, or what's kind of BitGo's stance on that? When they, it's not like if they come, it's when they come.
Yeah.
So what is kind of BitGo stance on that?
We're working with some of them. So I think that there's going to be the traditional people coming in, and they're going to try and do asset management like they've always done, and maybe that will work. They've got a lot of relationships. Maybe it will work. We'll be okay because we're there to help them do that too. On the other hand, if BitGo is successful and when we're successful, we can look into building on top of all these traditional ways of asset management, and we can apply newer parts of the blockchain to them. So, for example, you can stake coins on certain blockchains, and you can use your funds on certain blockchains to enter into smart contracts. And that may not be something that every custody provider is going to offer. So I think that we're really excited about being able to offer not just custody, but what's next on top of that and use blockchain technology there. But if traditional finance comes in, we'd love them to come in. Let's get everyone to be a part of this digital currency industry, and welcome them in too. And we're not so afraid of that. I think everybody's got a place in this.
So we have about five more minutes left. So just want to ask everybody here, are there any emerging wallets or storage technologies or security devices or technique that you're excited about?
I think enterprise solutions need a lot of help, and there's some interesting people in this room. Ken Sedgwick, if you want to talk to him afterwards, him and his team are working on a pretty interesting solution for helping storage and custody solutions for exchanges, mining facilities, and other larger holders of cryptocurrency. So I'm kind of looking to smart people in the space like Ken and his team for solutions like that. BitGo is also working on some really interesting stuff. But I think you're going to see probably the pioneers of the industry make some stuff, and that includes Ken and BitGo and places like that. And then I think you'll see traditional finance firms come in. So I'm kind of hoping that the early pioneers get it right, but if not, they'll always pick up the slack, and financial institutions will run from there. So there is some interesting technology, but I'm still kind of on the consumer side and waiting for something consumer focused to happen. And there is some interesting stuff such as node technology directly on a phone that doesn't store information on the cellular device, but instead on a node, and then you use that information to do digital transactions, whether that's digital assets or cryptocurrency. So that's something I'm kind of keeping my eye on, because if somebody became a node and is able to earn cryptocurrency from that and kind of replace the traditional proof of work that we've talked a lot about, that could be really interesting. I'm not that bullish on mining, even though I've been doing it for a while, and I think that something will probably replace, and we're already seeing that with proof of stake and other mechanisms. So I'm keeping my eye on the consumer side, and then on the very high side of financial institutions and how they're managing their money.
So what kind of business model do you see for these custodians? They take a fee?
They take a cut. They take a cut.
They take a
Yeah,
cut.
it's hugely profitable.
It's a fee, it's an annual fee, it's a basis point fee.
Basis point fee, oftentimes there'll be a fee to withdraw. And given this is going to be a huge business. But I did want to add, not to go away from the new things that I wanted to see.
Quick question on that.
Okay.
Is the fee structure for cryptocurrency custodianship, is that going to be more expensive than a traditional asset?
Hell yes.
Yeah. Oh, yeah.
I thought it should be less.
It's all
right? That's
expensive.
the whole motivation to.
No, it's on top of not enough regulatory clarity, every solution was really expensive and really slow.
Yeah, that's not the motivation. It wasn't to. Yeah, I don't think that's the motivation. Was to save on custodian fees. I don't think that's what they had in mind.
No, the transaction fee. Transaction fee. So they are moved to the custodians.
Right.
Yeah. So the end of the overall fee. Right?
So you cannot
dealing with banks.
fees.
I mean, I don't think you look at it like when there's a day. I mean, whoever invented Bitcoin probably saw a world, and maybe he's right, where everyone steals their own bank, and maybe we find a way that that's possible through technology improvements and user interface improvements someday. Probably this was not the world that Satoshi saw, just not the end game. But what he did see was a world where nobody could manufacture Bitcoins beyond 21 million, and I think that very much is still true.
I'd say the formula is pretty easy if you want to talk about custodial fees or any fees for transacting any kind of asset, whether it's digital or tangible. And that's that if it's harder to interact with, meaning that the amount of people that have control of that asset or own that asset is fewer, it will be much more expensive. So if you want to talk about trading a dollar is relatively inexpensive, and that's because it's very mass distributed. If you talk about cryptocurrency, it's less so. So it's more expensive. If you talk about gold, it's less than the dollar, so it's more expensive. So the more rare the asset, or the more confined in the amount of people that actually own it, it's usually more expensive to transact with.
Thank you. I think that's all the time we have.
How do you, in the digital asset security space, how do you map physical assets into the digital equivalent, right? Is that an easy thing, or trying to?
Yeah, there's a couple projects on the supply chain side that are doing this with QR codes, but even then you still have the compliance issue with, you're putting non-GMO, organic on.
How do you still, validate that the digital equivalent, the physical is almost always in sync, right? Because
There does tend to be a disconnect, and I think it just does come down to the emergence of new regulation and the maturity of the space in general.
So we're going to have to wind up now, unfortunately, but thank you so much to all the panelists.